We all think massive corporate groups totally rule the world, right? We assume they are these hyper-efficient machines with absolutely everything under control. Well, get ready, because the actual data tells a completely different, frankly shocking story. Welcome to This Explainer, where we're going to decode a massive wealth myth. Do you think megacorporations are ruthless, efficient moneymakers? Or maybe you think they're perfectly designed machines just for stealing wealth? Think again. Big companies aren't efficient at all. In reality, they are absolutely terrified, and corporate financial data totally proves it.
Let's get right into Section 1, the big corporate myth.
For years, experts have been pulling their hair out over a massive question. Why do big corporate families move so much cash around internally? Theory 1 was always that it's just smart investing. Theory 2, pure greedy stealing by the insiders. But guess what? The data completely destroys both of those ideas. The real answer is way darker. It's desperate life support. They are secretly keeping zombie companies alive.
Moving right along to Section 2, survival over profit.
To really uncover how this works, researchers dug deep into Indian business groups between 1989 and 2001. Why then and there? Because the law actually forced them to report every single internal loan, and the results are mind-blowing. The cash flows straight to the absolute weakest, highest debt losers in the group. We're talking about a staggering 75% of internal loans being pumped directly into failing companies. The healthy sister companies are literally draining their own bank accounts to do this.
And these aren't just tiny little favors between friends. This bailout money makes up a massive 59% of the failing firm's operating profits. Think about that for a second. Without this secret family cash flowing in, they wouldn't just be struggling, they would be instantly dead.
Think about it this way. If these high-debt, failing companies walked into a normal, everyday bank, they'd literally be laughed out of the lobby. I mean, no sane banker would ever touch them. But inside the corporate family, it's a whole different story. They get huge loans at rates 10% cheaper than what they'd get on the open market. And it gets crazier. Nearly half of these internal bailout loans demand exactly 0% interest. Zero is totally free life support. 48% of these massive cash transfers come with absolutely no strings attached. So much for the myth of corporate efficiency, right? Smart banks definitely do not give millions in free money to chronic losers.
Okay, let's look at Section 3, the terrifying domino effect.
So, you're probably asking, why on earth would they give away all this free money? 2 words. Panicked self-preservation. See, the very second a single firm in the group declares bankruptcy, outside lenders completely freak out. Credit to the healthy firms gets slashed by 21%. Group-wide investments suddenly plummet by 45%, and the risk of the next sister company going bankrupt, it spikes by a terrifying 53%. Even the healthy, profitable sister companies get utterly destroyed by the panic. Their profitability literally drops 32% right after that first bankruptcy hits. The entire market just suddenly stops trusting the brand. It is pure financial contagion. When one domino falls, the whole empire is suddenly fighting for its life.
Let's break down the exact numbers in Section 4, unpacking the data.
So, does sacrificing all this cash to prop up the weak companies actually work? Technically, yes, it does. Thanks to these secret internal loans, a firm inside a group has a 34.5% lower risk of going bankrupt than an independent company does. By pooling their resources, they successfully cheat death.
But hold on, because this is definitely not smart business. These failing companies don't use this free cash to innovate or turn things around. Not at all. Their operating profits just keep on sinking. Their stock returns stay completely negative for 2 solid years. They are quite literally corporate zombies, kept alive on life support purely to stop the other dominoes from falling.
Which brings us to our final part, Section 5, research flaws and impact.
Now, before we start praising these corporate groups for saving the economy and preventing total collapse, we really need to look at the legal environment of this data. In modern systems, when a company goes bankrupt, the creditors take over. The old managers get kicked right out the door. But under India's 1989 law, the failed managers legally got to keep their corner offices and all their perks, even during bankruptcy. This bizarre legal loophole meant the insiders had every single selfish reason you can think of to prop up these zombies. If letting a company die meant losing their fancy titles, their private cars, and their unmonitored spending,
Well, of course they drained the healthy companies to stop it. They were highly motivated to avoid any formal bankruptcy scrutiny.
Which leaves us with one seriously uncomfortable question. Did these corporate titans save their failing companies to protect the broader economy and stop a market panic? Or did they just drain millions from their own healthy, successful businesses simply to protect their private, luxurious perks? The data shows exactly what they did, but the ultimate motive behind it? Well, I'm going to leave that for you to decide.